Hello, everyone. Welcome to another episode of Options Discovery. Today, I'm sitting down with Doug Engmann. Doug, can you give me an overview of your background and how you got to where you are today?
Thank you. I'm actually was an Army brat. I was born in China, grew up in Japan, Hawaii, Australia, Chicago, and then moved to San Francisco, where I was lucky enough to go to UC Berkeley and then MIT for my master's degree. I then worked at the White House, which was interesting in the early 70s, and was a management consultant in public sector. But in 1977, my brother, who'd already been interested in securities, joined the Pacific Stock Exchange as a market maker. And I joined him in a partnership trading as market makers on the floor of the Pacific Stock Exchange options floor, which began in 1976. And from there, we traded. We built a options clearing firm in San Francisco, which was the first options clearing firm west of the Mississippi. Actually, was the only one founded west of the Mississippi. And from there, I got very active in stock exchange affairs. I became chairman of the stock exchange in 1987 for a year, and ended trading in 1991, and ran our options clearing business and related stock execution business. Served on the board of the Options Clearing Corporation. I was the first options representative on the National Securities Clearing Corporation in the 90s. We sold our businesses first to ABN AMRO, and I ran ABN AMRO's global options clearing and execution business, including futures and prime brokerage. Then we sold our related business to SocGen, and I was head of North American equities for FEMAT, which is the future subsidiary of SocGen. Retired, then got back into the business with the acquisition of SageTrader, which was an introducing broker serving professional traders. And I just sold that business, and I'm doing consulting right now in the derivative space.
And when you first started out, did you envision yourself being as involved in the options industry as you are today?
No, when I first started out, I was a market maker focused on learning how to trade on the floor. And back in the 70s, options were a new thing. And so you had to understand what all the nuances were of trading options. And then, of course, we started out with call options and then introduced put options, which confused everybody at first. But no, as I got involved in exchange politics, then I got involved with basically what some of my brother and my traits are, is how to solve problems in the industry. And as the options industry was growing, there were a lot of challenges, and we focused on solving problems for that. And as a result of doing that, you get more involved with the industry.
And I know you were just talking about it, but early in your career, you were a market maker for the Pacific Stock Exchange. So what are some experiences from the exchange that stuck with you throughout your career?
Well, back when the Pacific Stock Exchange started trading options in 1976, there were only basically 3 options exchanges. Then there became the 4th. We were the 4th, and I think the NYSE was the 5th. And back then, the exchanges that started earlier got all the good stocks. So IBM and all of the Nifty 50 were being traded at other exchanges. So we had to take stocks that were less active. And as a result, they didn't trade as often. So at the Pacific, you had to learn how to trade options, not as a day trader, but holding positions. And in holding option positions, you have to understand the Greeks, the deltas, the gammas, and the vegas. And those of us on the Pacific became really very good at understanding values, how to spread, and how to make money based on not buying 1 minute and selling another minute, but holding the positions until when they were out of value and selling them when they were in value. And that's the one thing I remember from the Pacific was uh, um, learning how to trade the values of options. Um, and there were some pretty prominent options traders who took that back east. Blair Hull, for example, was one of the top value option traders, or Kessler. They eventually moved to Chicago. My brother and I decided that we would rather live in San Francisco than live in Chicago.
Well,
The only thing I'd rather remember from the Pacific is in 1989 we had an earthquake that closed the Pacific Stock Exchange down for 4 days, and I was involved with the move of the Pacific options floors to Chicago, New York, and Philadelphia, which I've done an interview with John about. It was an extraordinary experience to transfer the floor trading of one exchange to 3 other exchanges in basically a day and a half.
that must have been a pretty stressful experience. I'm sure that
Um,
stuck with you.
yeah, that was an incredible experience, but it showed how the options industry at that point in time, while we were competitors, were concerned about the overall general health of the industry, and everyone accommodated the issue that we had, and we were very, very grateful.
Well, thank you for sharing a little bit more about your background and how you got to where you are today. I want to talk a little bit more about portfolio margining, its history, and obviously your role in bringing it to life. But before we get into that, can you explain how portfolio margining works and how it's used for options?
Well, portfolio margining basically changes the way you're required by the Fed and the SEC to carry cash in order to support the risk that you have in your option positions. And under Reg T, which is the traditional way that retail traders have been optioned, they pretty much apply the margin rules to each individual position. And while there are some rules that allow you to offset your margin in related positions, is very, very limited. So if you own stock and you own a put, you have to put up pretty much 50% of under Reg T of the value of your stock and 50% of the value of your option, even though the put protects the value of the stock as it goes down. Portfolio margin takes a different approach. It looks at all of your positions in a related issue and calculates really what the risk is of those positions in a combined fashion based on certain market movements, and charges you a margin equal to what that risk happens to be. And so it's a great way of allowing people who have offsetting option positions, both longs and shorts, and offsetting stock positions, longs and shorts, to have a lower margin because they've basically been able to hedge the risk of those overall positions.
So, knowing this, what kind of options trader would be interested in portfolio margining?
Well, basically the most beneficial aspect of portfolio margin goes to people who are what I would call spreaders, or who trade actively, but trade actively both long and short in an issue and have positions that are offsetting, because they are able to get the benefit of being margined on the risk in their position as opposed to the total gross value of their positions. Now, day traders have some benefit from portfolio margin because the initial margin they have to put up for a long position is not as much under portfolio margin. It's not 50% because portfolio margin evaluates your risk down 15%. And so when you sell and buy again, you only have to have maybe a third of the cash that you would need as a day trader. However, the SEC and FINRA have rules about how much equity you need to have in your account as a portfolio margin customer. And then certain brokerage houses have minimums as to what you need in order to be able to day trade under a portfolio margin account. And so it's most beneficial to people who have multiple positions. It's somewhat beneficial to people who have are day traders or are long or short on one side of the market. They don't get the greatest benefit, but there is a benefit there.
So now that we have a little bit more context on portfolio margining and what it is, can you talk more about the history of portfolio margining and specifically your role or the role you played in bringing it to the public?
You have to understand a little bit of a history. Back when options started to be traded, everything was regulated under Reg T, the traditional way that stocks happen to be margined. And again, margin is the amount of cash you have to have in your account to be able to support a particular position. And generally, it's 50%. There are some initial margin, and the margin requirements change as you hold your stock, but it's a fairly high amount. Option traders had an exemption from Reg T because they all had to be broker-dealers. And broker-dealers have different capital rules. They're not really margin rules. They have different capital rules as to how much money they have to have in their account in order to support the positions that they carry. And those are much more beneficial than Reg T, but nowhere as beneficial as what portfolio margin provides. Now, back in the late 80s, the concept of portfolio margin applying to broker-dealers that held option positions was called risk-based margins. And risk-based margins back in the 80s were the predecessor for portfolio margin. And at Sage Clearing, which was the clearing firm that my brother and I founded, we were one of the pioneers in an SEC pilot project in the late 80s to test out risk-based, they're called risk-based haircuts or risk-based margins for option market makers who were broker-dealers, of which they all had to be. And we got a lot of experience in understanding how risk-based haircuts, capital requirements for options traders were in the late 80s and early 90s. And then that was adopted by the entire industry throughout the 90s for, again, broker-dealers who were options market makers. The exchanges felt, the CBOE, the Amex, the Pacific, that the same concept could apply for retail customers, people who traded options that were not broker-dealers. And they dubbed that portfolio margin. And for a long time, they had discussions with the SEC and FINRA about applying portfolio margin to retail traders. Well, I have to say the SEC in the 90s had a fairly conservative staff and were very worried that allowing portfolio margin for retail customers would allow people who didn't really understand options very well to take riskier positions, because basically under portfolio margin, as under risk-based haircuts, because your margin is lower, your leverage is higher. And they were very worried about giving retail customers more leverage. That changed in around the mid 2000s. In 2004, the SIBO got approval at the SEC to allow portfolio margin under a pilot project. The SEC finally blessed that in 2005. And at that point in time, a broker-dealer could, under the SEC pilot test project, take on retail customers as portfolio margin candidates. Now, the reality is that, you know, if you're a Schwab or a TD Ameritrade or whatever, and you have 5 million retail customers or 1 million retail customers, you were a little reluctant to want to go into that business, because if you did it for one, you'd have to do it for all. So at that point in time, we had sold one of our businesses to Société Générale, the French bank, to its future subsidiary called FEMAT. And we were the equity division of FEMAT. And we had a lot of what I would call professional traders, traders who were not market makers, but traded actively in options, technically as retail customers. But we also had a lot of small hedge funds that were trading options as well. When this was approved by the SEC in 2005, my CFO, who had been with me since 1980, said, "Doug, this is just like risk-based haircuts that we were doing in our older firm, Sage, our former sister firm, you know, for 15 years. We can do this." And so we applied to the SEC and became the first broker-dealer brokerage house on the street to pioneer portfolio margin. And we were the only ones for about 18 months to test it out. And no other brokerage went near it. And we brought on our professional customers and many, many hedge funds into portfolio margin. And that's kind of the primary role we played, is we really pretty much introduced it to the industry. Now, there are a lot of other nuances about that, which I know you have other questions about.
Yeah, so I think you were kind of talking a little bit about it before, but I guess what caused you to pioneer the idea of portfolio margining?
Well, one was because we had done it before, the same concept to market makers, and we understood it, and we understood the risk and the risks and how to manage the risk of the greater leverage. But secondly, we had just sold our sister firm to Sage. It was called Preferred Trade, to SocGen FEMAT. And we were, again, when you're acquired by a larger firm, there's always expectations that you're going to expand your business. And we thought this was a great opportunity to expand FEMAT's name. FEMAT was known as a futures firm in the equity and options industry, is to go out and promote portfolio margining to our existing customers and our future customers. So between mid 2005 and the end of 2006, I must have attended 30 different industry conferences for prime brokers, hedge funds, exchanges, even some retail businesses, where I would explain the benefits of portfolio margining over Reg T for these customers. And that spurred us on because the response was absolutely incredible. I would make a presentation to a group of hedge funds, And I would show a graph to show the differences between a very simple married put. For those of you who haven't watched your programs earlier, a married put is your long stock and your long a put to protect the downside. And at that point in time, IBM was trading about 100, and you can buy an at-the-money put for $5 that might expire in 3 months. So you were protected pretty much below 95. And because if you paid $5 for the put, it goes to 95. You've lost $5 in your stock, and your puts, you've lost $10. So basically, it protects you below 90. Under Reg T, the margin for that, holding that simple position, was $55,000. Under portfolio margin, it was about $2,500. Now, maybe it's a little bit more than that. Maybe it was closer to $3,500, because you would look at how much you would lose down 15%, and you'd lose $15,000 in your stock, and you'd make $10,000 in your option. So actually, your margin would be $5,000. $5,000 versus $55,000. When I put that up on a chart, you could hear the gasps from the crowd. I mean, they were just amazed that this could have been approved. And so that motivated us. We got a lot of customers. The one customer that exemplifies how a spread trader can benefit had a huge position in, back then, the SPX options, the Standard & Poor's 500 options. And, he had thousands of calls and puts offsetting each other. His total margin under Reg T was something like $2.5 million. Under portfolio margining, when he became a customer of ours, it went down to $200,000. So you can imagine the attraction. Now, there are requirements for non-broker-dealer customers, even hedge funds and retail customers, to get portfolio margin. You have to have a certain amount of equity. You have to qualify. You have to understand what the risks are in leverage, and particularly in short options. So not everyone is totally qualified to trade and get portfolio margin. Now, just a side note, unfortunately, there are a few brokerage houses that didn't really follow those rules that strictly, particularly during the GME run-up and the Reddit experience that we had 3 years ago. But those are the rules, and so not everyone could get portfolio margin. Only those people that understood options really very well, and the leverage that's involved and the risk involved with that leverage.
So I know you talked a little bit about how you got portfolio margining kind of publicized and accepted. Was there any other ways you got portfolio margining accepted by the mainstream options industry?
Well, I can't take credit for getting it accepted by the mainstream. I mean, I was interviewed dozens of times by the blogs and newsletters that were out there, kind of explaining what the nuances were and what we had to do. And the other way we got it accepted was not so much it was by the other brokers, because I think the other brokers, when they saw that we took this business on, and we were we were owned by SocGen. We were a big bank, but running as a small futures broker as a subsidiary, that we didn't lose a lot of money. People didn't blow out. We didn't have issues, and they saw how we could do it. I think they started to see the benefit of slowly moving into the space. And the big firms at that point in time Morgan Stanley, Bank of America, Interactive Brokers, they started to adopt portfolio margin once the SEC finished its pilot project and opened it up to everybody, which was at the end of 2006 or early 2007.
And how influential do you think portfolio margining has been in the options industry?
I think it's been revolutionary because you now have traders with the ability to be margined on their risk rather than what their gross positions are. And I think it's opened up a lot of opportunities to particularly active traders in options or to more traditional retail traders who have sophisticated spreads that they want to put on in order to capture the values that are inherent in options when they get out of line. And I don't know how many right now, how many portfolio margin accounts there are in the country, but I'm sure there are millions. And if you look at the growth of options trading since portfolio margin was adopted in 2000, 2008, it's skyrocketed. And every year, portfolio margin has grown. And the interesting thing, it's had a secondary effect in the equities market because for two reasons. One, now you can have equities in your options group. And a lot of people trade options on the equities that they trade. The equities can be considered in that position for portfolio margin. But also what the SEC did, and we weren't sure this was their intent, but they said you could get portfolio margin even if you didn't trade options. So even as early as 2007, 2008, if you qualified for portfolio margin and you had that same IBM position at $100, where your initial margin be $50,000, under portfolio margin, the first day would be $15,000. So it would go down a third. And again, that was a surprise to those of us in the options industry, but the SEC allowed that. We don't know whether it was by accident or not, but they haven't changed it. And now you have a lot of equity traders who understand options leverage, because you still have to qualify to understand options leverage, even if you're just trading equities. And so I think it's helped boost equity volumes as well for those two particular reasons.
So those are the main questions I have for you today. I have a few final questions just to wrap up our conversation a little bit. The first one is, what are some of the most important lessons you've learned while working with derivatives in your career?
The most important lesson is, and I hate to be crude, you have to be careful with options because there's always a new situation in an option position that's going to bite you in the ass. Pardon my, what a lot of younger, newer option traders don't really understand is that there are, I don't want to call them hidden risks, but there are unusual situation risks that you have to be aware of if you're trading a lot of money in the option space. And for example, there's pin risk. A lot of people don't understand what pin risk is, but pin risk is that if you're long and short an option in a stock or an equity or an index, and it closes at the strike price, if you're short an option, you don't know whether you're going to be assigned or not. And if you're long the option as part of a spread, you might be exercising it without having the offsetting stock position. So pin risk is something that everyone has to keep in mind when they're trading options, particularly spreads. or options versus stock. Some of the other ones, there's volatility risk. Now, a lot of people understand volatility risk, but they understand it in a very narrow sense. Volatility risk exists. I mean, I've had clients in unusual situations where they're short calls and long stock and in a covered right, and the stock drops and the price of the calls go up. That's not supposed to happen, right? But that can happen when the perception of volatility goes up significantly, that all of a sudden the prices of all the options go up despite what the stock happens to be doing. And again, volatility risk applies not when you're just long or short options, but when you're hedged. There's another thing called dividend risk. A lot of option traders don't understand that, the stock price is adjusted for dividend, and they wonder why their option prices don't change, or they're short options and they get assigned on a dividend, but they don't exercise their long options for that particular dividend. And again, there's dividend risk. Just recently, we had somebody that had a box on, which is, your long and short options of two different strikes, and you get assigned on one. Well, a box has very low portfolio margin. The minute you get assigned on one, your box margin can blow up. Actually, that's not so much in portfolio margin, but in Reg T margin. So there are all these nuances that, if you're an active options trader, that you should be aware of. That's the one thing I've learned over the year of the industry. I manage risk of hundreds of market makers and hundreds of thousands of retail clients. As a risk manager, they're always forefront in your own mind, because the simple, you're going to lose money when the market goes down, you're going to make money when the market goes up, or vice versa, doesn't always apply in these types of special situations.
So every week we choose a different topic for the show. Do you have any recommendations for a topic that we could cover next to learn more about options?
Well, I would cover, just what I talked about. Because I don't see that that's been covered in your prior interviews, though I haven't listened to all of them. But the one thing is that how to look at what I would call hidden risks or opportunities that you can have that don't come right at you by looking at option prices and the Greeks and the spreads. That would be the one topic that I think you could bring on that would be very educational for your audience, particularly more sophisticated and active option traders. And I can give you a few names of people I think you might want to interview, but we could do that offline.
All right. Well, that is all I have for you today. Thank you again for coming on. I know I learned quite a bit, and I'm sure our viewers did too.
I appreciate it. Thank you for the opportunity. Options are great. Portfolio margin is tremendous, and it's a great industry, and you can make a lot of money if you know what you're doing. So good luck to all your viewers.
All right, for everyone else watching, I'll see you all in the next episode. If you're hungry for more options content, make sure to subscribe to the JLN YouTube channel and check out our social media accounts. Be sure to check out our website, johnlothiannews.com, Markets Wiki, and the John Lothian newsletter for more content.